Hello class, and welcome to the video lecture for Statement of Cash Flows. The first learning unit covers the basic elements of a statement of cash flows and how to prepare one using the indirect method. The statement of cash flows is the fourth major financial statement. It summarizes the sources and uses of cash by a company during an accounting period. It's easy to compute the change in cash balance by looking at the comparative balance sheet, but just the change in total cash tells us nothing about specific cash transactions. The statement of cash flows shows in detail the sources and uses of cash. There's two methods used to prepare the statement of cash flows. The first is called the indirect method. When the indirect method is used, information from other financial statements is used to determine cash flows. These statements are the income statement, statement of retained earnings, and the balance sheet. In order to compare balances shown on a balance sheet, we need two, which is often referred to as a comparative balance sheet. The statement of cash flows consists of three main sections. First, cash flows from operating activities. Second, cash flows from investing activities. And third, cash flows from financing activities. Operating activities include selling products or services to customers. Cash inflows from operating activities include cash collected from customers, such as selling merchandise or providing services. It also includes interest and dividends received. Cash outflows from operating activities include paying for merchandise inventory, salaries, taxes, interest, and other similar expenses incurred in day-to-day operations of running a business. It does not include the payment of dividends to stockholders. Investing activities include such things as purchase or sale of plant, property, and equipment. Cash inflows from investing activities also includes collecting on loans, such as notes receivable, or buying and selling stocks and bonds of other companies. Cash outflows from investing activities include giving loans to others. Financing activities include raising money by issuing stocks and bonds, repurchasing of the company's own stock, and paying cash dividends to stockholders. Notice the cash outflow section says repayment of long-term debt, and in parentheses it says principal. This is because only the portion of the payment that applies to the principal is included here. The portion of the payment that goes to interest is listed in the operating activities section. The fourth classification on the statement of cash flows is called non-cash investing and financing activities. These transactions don't involve cash and don't appear in any of the regular three sections. Instead, they're noted at the bottom of the statement using words to describe them or in a separate schedule. A common example is if stock is exchanged for property such as land. This is considered significant to the company, but no cash has changed hands. At the beginning of the learning unit, I mentioned there's two methods of preparing a statement of cash flows. These are called the indirect and the direct method. The difference is in the operating activities section. The investing and financing activities section is the same for both methods. Using the indirect method, we start with net income and then reconcile net income by adding and subtracting differences in general ledger accounts to arrive at cash provided by operating activities. Using the direct method, we don't reconcile. We simply list all the cash inflows and cash outflows. Let's start with the indirect method. To follow along, you might want to have the textbook open to pages 740 and 741 so you can see the financial statements we need to use. Here we have an income statement for Zabel Company. We start with net income, which is $9,960. Net income is based on accrual accounting, which recognizes income when it's earned and expenses when they're incurred. But that doesn't necessarily mean we've received or paid cash for everything here. For example, our amount of sales is $190,000. Do you think we received cash for all that? What if we have an outstanding accounts receivable? If we have an outstanding accounts receivable, we haven't received that cash. Another example is depreciation expense. Depreciation expense decreases net income because it's subtracted from gross profit, but does the company pay any cash for depreciation? No. Yet another example is salaries expense. The company incurred $51,040 in salary expense during the year, but how do we know how much of that was actually paid? The final payday might be in January, so we might have a salary payable on the balance sheet. That would mean we have actually paid less, in terms of cash, than the amount listed as an expense. Now let's review the statement of retained earnings. This is where we find dividends. It says we have cash dividends of $8,000, but this is the amount of dividends that's been declared, not necessarily the amount paid. We'll have to see if the balance sheet has any dividends payable in order to determine if we paid out the entire $8,000. Now we have a comparative balance sheet. A comparative balance sheet lists 2 or more years side by side so they can be compared. The first column is 2014 and the second column is 2013. Remember that the balance sheet is a listing of all permanent accounts and their balances at the end of the year. Let's go through these one at a time to get an idea of the effect they might have on our statement of cash flows. First, we have cash. When we create a cash flow statement, we will use these numbers to reconcile, which we'll see in a couple minutes. Accounts receivable has increased by $4,840 in 2014. That means, of all of the sales that were made, $4,840 is yet to be received as cash since the accounts receivable is still outstanding. Merchandise inventory decreased by $2,000. That means we used a bit more inventory than we paid for that year. Prepaid insurance increased by $200. That means we bought an additional $200 worth of insurance in addition to what we have as an expense. Now we have the property, plant, and equipment section. Remember that these items go in the investing section of the cash flow statement. Office equipment increased by $30,000, so we must have paid $30,000 in cash. And that's a cash outflow in investing activities. I've split the balance sheet up into 2 slides so it's easier to see on the screen. Here we have the second half of the balance sheet starting with the liabilities section. We have a note payable, which it says was used to purchase inventory. This is just like having an account payable. It increased by $2,600 in 2014. This means we have unpaid bills in the amount of $2,600. Which tells us that we didn't pay for all of the inventory listed on the balance sheet. In fact, we didn't pay for $2,600 worth of it. Our regular account payable account has decreased by $1,000. That means we paid $1,000 more than our expenses listed on the income statement. Our long-term note payable increased by $8,000. This means we borrowed an extra $8,000 in 2014. Which is a cash inflow. Long-term liabilities are considered a financing activity, so this is a cash inflow of $8,000 from financing activities. Finally, let's look at the stockholders' equity section. We can see that common stock increased by $1,000 and paid-in capital increased by $9,000. That means we issued stock, which we received cash for in the amount of $10,000. Here we have a statement of cash flows derived from the information we have available to us from the other financial statements. The format starts with the section title. The first section is cash flows from operating activities. In this example, we're creating a statement of cash flows using the indirect method. Using the indirect method, we start with net income from operations, which was from the income statement. It's $9,960. The first thing is to add back is depreciation expense. Remember that depreciation expense is not a cash transaction. It made net income lower, but wasn't a cash outflow, so we add that number back. Our goal is to get from net income to cash provided by operating activities. The next item is accounts receivable. Remember that sales on the income statement increases net income, but we discovered that we didn't receive cash for the entire amount because we still have accounts receivable. So we have to subtract that amount from net income. The next one is a decrease in merchandise inventory. This one is tricky. The income statement listed cost of goods sold, which represents the cost of all merchandise inventory we paid for that year. But we also discovered that our inventory level decreased. This means we didn't actually pay for all of the cost of goods sold on the income statement. We must have used some inventory we acquired in the previous year. We need to add this amount to net income to account for it. Next, we have the increase in prepaid insurance. We paid for $200 more in prepaid insurance in 2014, so we subtract it from net income. Next, we have an increase in notes payable. Since it increased in by $2,600, we have $2,600 of bills we haven't paid yet. Since we haven't paid them yet, we add that back into net income. Finally, we have a decrease in accounts payable, which is subtracted from net income. The final step is to find the bottom line after all these additions and subtractions. We have a net cash provided by operating activities. We use the term provided by because it's a positive cash flow. If it were negative, we would say net cash used by operating activities. So I've never met a student who caught on to the statement of cash flows immediately, so you might find this little cheat sheet handy. When creating the operating activities section of the cash flow statement using the indirect method, follow these rules. If the balance in a current asset account has decreased, add it to net income. If it's increased, subtract it. Increases and decreases in current liabilities are just the opposite. Now we have the section called Cash Flows from Investing Activities. This consists primarily of cash inflows and outflows due to sales and purchases of property, plant, and equipment. By looking at the comparative balance sheet, we could see that store equipment increased by $30,000, so we must have paid $30,000 for it. We note that with a line simply saying purchase of store equipment, or in this case in your textbook just says purchase of plant asset. That's fine. We end this section by stating net cash used in investing activities, even if it's only one line. You do want a subtotal of each section presented this way. Notice we use the words net cash used, not net cash provided. Spending money on a purchase means money was used, not provided. Finally, we have the section called Cash Flows from Financing Activities. This is where we list cash inflows and outflows from long-term debt, such as long-term notes or bonds, as well as the issuance of stock and the payment of dividends to stockholders. We had determined our long-term debt increased by $8,000, so we would have received cash for that. We also determined we issued common stock, which is a cash inflow of $10,000. We also saw that we had dividends paid of $8,000. This was on the statement of retained earnings. We didn't have a dividend payable on the balance sheet, so we must have paid it all. The final line is net cash flows provided by financing activities of $10,000. Since the net amount is a positive cash flow, the cash was provided rather than used. Here we have the cash flow statement in its entirety. We have the three sections we just completed. At the bottom, we total up the three sections. 20,420 provided by operating activities, minus 30,000 used by investing activities, plus 10,000 provided by financing activities, means a net increase in cash of $420. That's the net increase in cash for 2014. If we take the cash balance from 2013, which is the beginning cash balance for 2014, and add $420, we get an ending cash balance of $2,900. This should be our ending balance of cash for 2014. I'd like to wrap up this learning unit with a problem from the book. So let's do 21B on page 757. It's at the bottom. You might want to give this a try on your own before we go over it. And use the format on page 743 as a guide, and the rules for increases and decreases on page 742. So I have the information presented in the textbook right here. It says from the income statement and balance sheet, along with the additional data for Dean Company, prepare a statement of cash flows using the indirect method. So we have our additional data here. All plant and equipment was purchased with cash. We sold an additional 7,000 shares of stock for cash at par. A $1,500 dividend was declared and paid, and short-term notes are used to finance inventory. What I have here on the right side is just the beginning of the cash flow statement. I've started with the title, the company name, the name of the financial statement, which is Statement of Cash Flows, and the year for which the statement is presented. For the year ended December 31st of, I put 2014 in here, but we're actually doing 2012. And I know that because my income statement and my balance sheet are for 2012. Okay, so the first step is to start with the operating activities section. So I'm going to title the section just like they have in the textbook, Net Cash Flows from Operating Activities. Okay, and I start with net income. When using an indirect method, you always start with net income. And so I'm going to put the amount of net income to the right, and I get my net income from the income statement. So that's $38.50. Okay. Now I'm going to start reconciling from net income to net cash flows provided by operating activities. So all I'm doing here is following the format in the textbook. So I'm going to add or deduct items to convert net income from accrual to cash basis. The first thing you want to do when you're completing a cash flow statement using the indirect method is to add back in any depreciation expense. So I'm just going to list that here, depreciation expense. And I get that amount from the income statement, $7,100. So you always add back in depreciation expense first. Now what I want to do is I want to start going through the current assets on the balance sheet, one at a time, looking for increases and decreases. So my first one is cash. but that's not an increase or decrease. It's used to reconcile net income to net cash flows. So we'll move on to the next one. Accounts receivable. Accounts receivable was $5,900 at the end of 2012 and $4,400 at the end of 2011. So accounts receivable increased by $1,500 over the year. So I go up to my cheat sheet here and I look at current assets, and if current assets has increased, then I deduct this amount from net income. So I'm going to title this here Increase in Accounts Receivable. So I deduct it, so that's negative $1,500. Okay, now I move on to the next one in the current assets section of the balance sheet. Merchandise inventory. At the end of 2012, it was $2,600. At the end of 2011, it was $2,100. So that means my merchandise inventory increased by $500. So again, I use my cheat sheet up here. Current assets. If their current asset has increased, then I deduct it. Okay, so I'm going to write increase in merchandise inventory, and I'm going to deduct the $500 increase. Okay, now I'm going to move on to the next item under current assets, which is prepaid rent. Prepaid rent at the end of 2012 was $900. At the end of 2011, it was $1,300. So that means it decreased by $400. So using my cheat sheet here, current assets, if current assets has decreased, then I add to net income. So I'm going to go back over to my cash flow statement and type decrease in prepaid rent, and I'm going to add the $400. Okay, now I'm done with the current assets section of the balance sheet. I move on to current liabilities. Okay, current liabilities, the first one is short-term notes payable, which was $7,000 at the end of 2012 and $5,600 at the end of 2011. So short-term notes payable increased by $1,400. So using my cheat sheet at the top, I see that current liabilities, if current liabilities has increased, then I add that amount to net income. So I'm going to go back to my cash flow statement and type in increase in short-term notes payable, and I'm going to add that increase of $1,400. Okay, going back to the current liability section of my balance sheet, the next one is accounts payable. Accounts payable was $4,150 at the end of 2012 and $4,600 at the end of 2011. So that means in 2012, accounts payable decreased by $450. So using my cheat sheet, I see current liabilities decreased means I deduct that amount from net income. So going back to my statement of cash flows, I'm going to type in decrease in accounts payable, and I'm going to subtract $450. Okay, so just to summarize this, how to get started in this section, you start with net income, and then you add and subtract changes in current assets and current liabilities. We went through the current assets, and we went through all of the current liabilities, and you always start with depreciation expense, and you ignore the change in cash, because that's actually what we're trying to reconcile here. So So I've looked at everything here, and now I want a subtotal. I want to take my net income and add or subtract all of these items that I determined were increases and decreases. So I'm just going to do a sum here. You can do this manually if you want. And I arrive at $10,300. So that's a positive cash flow. So my bottom line here to summarize net cash flows from operating activities, it's going to be a net cash flow provided by operating activities. Okay, now if this was a negative number, it would be net cash flows used by operating activities. But that's not the case. It's net cash flows provided by operating activities. Okay, now I'm going to move on to the cash flows from investing activities. Okay, so I title my section Cash Flows from Investing Activities. Now I want to look at the changes in items that are investing activities, and that includes purchases and sales of property, plant, and equipment. So I go to my balance sheet, to the property, plant, and equipment section. I see that store equipment at the end of 2012, this is actually a typo in the textbook. The store equipment at the end of 2012 is $56,200. There's a typo there. It says 5,620, but it's missing a zero. It's supposed to be 56,200, and at the end of 2011 the balance was 48,000. So that means that store equipment has increased by $8,200. So that means that the company purchased an additional $8,200 worth of store equipment. So I'm going to add that, or I'm going to put this line item in cash flows from investing activities. Purchase of, I'm going to call it a plant asset just to be consistent with the textbook. But if you were actually doing this for a business, it would be perfectly fine to type purchase of store equipment. So if we purchased an additional $8,200 worth of store equipment, that's a cash outflow. We paid for that. So I'm going to subtract that. Now I'm going to finish this section because that's the only item in the plant and equipment section. You can ignore accumulated depreciation. Sometimes you do need to analyze accumulated depreciation in order to determine the exact amount of cash inflow or cash outflow, but your textbook isn't giving you anything that's that complicated. You might see something more complicated in an intermediate accounting class. So for now, just ignore the accumulated depreciation account. So I'm going to summarize this section here with net cash flows used by investing activities. And it's used because it's a cash outflow. Okay, now I'm going to move on to the third section. Cash flows from financing activities. Okay, so for cash flows from financing activities, I want to look at the long-term liabilities section of the balance sheet and stockholders' equity. In the long-term liabilities section, we have a mortgage payable, which at the end of 2012 was $10,000, and at the end of 2011, $17,000. So the mortgage payable was reduced by $7,000 in 2012. So I'm going to call this payment of mortgage, and that's going to be a reduction, so a negative $7,000. Okay, and that's all for long-term liabilities. So now I want to look at common stock, and the information was given here at the top, because they don't provide us with the statement of retained earnings, so they're giving us some extra information here, and they're telling us that we sold an additional 7,000 shares of stock for cash at par. Now if I go down to my information here in the stockholders equity section, it says the par value was $1, and we can also see that the ending balance of common stock in 2012 was $28,000. The end of 2011 it was $21,000. So common stock has increased by $7,000. So we must have issued $7,000 worth of common stock. I'm going to call this issuance of common stock. And is that a cash inflow or a cash outflow? Well, it's going to be a cash inflow because when you issue common stock, the purchasers are giving the company money. So that's a cash inflow of $7,000. Okay, now finally we have dividends. They don't provide us with the statement of retained earnings, but they do give us the information in the additional data for the problem, and it says a $1,500 dividend was declared and paid. So we have payment of dividends. So payment of dividends is a cash outflow, so that's a negative. Alright, and that's all that I have for cash flows from financing activities. So just to summarize, for the cash flows from financing activities, you want to look at the long-term liabilities section of the balance sheet, and you want to look at stockholders' equity to look for increases or decreases in common stock, or maybe treasury stock, but they're not giving us any treasury stock transactions here. And then you also want to look for the payment of dividends. So I'm going to summarize this section. Well, first I'm going to find my subtotal, actually. I'm going to add everything in the cash flows from financing activities. So we've got negative 7,000 plus 7,000 and negative 1,500. So the net amount there is negative 1,500, and that tells me that this is net cash flows used by used by financing activities rather than provided by. Okay, we are at the final and last part of the statement of cash flows. And if you refer to page 743, where it shows an example of the statement of cash flows, which I'm trying to follow along with that format, you see 3 lines at the bottom. These are always the same 3 lines. Okay, we start with our net increase in cash. Net increase in cash is the sum of each of these 3 sections. So we have net cash flows provided by operating activities of $10,300 plus net cash flows used by investing activities of $8,200 plus net cash flows used by financing activities of $1,500. Okay, so in using a formula here, I've just added negative numbers, so which I'm just subtracting them. Okay, so 10,300 minus 8,200 minus 1,500 equals $600. Okay, the next line is my beginning balance of cash. Oops. So where do I get my beginning balance of cash? This is a statement of cash flows for 2012. So I look for my beginning balance of cash for 2012. So I go to my balance sheet. So which one of these is it? Now remember, a balance sheet is for the end of the year. So my beginning balance of cash for 2012 would be the ending balance of cash for 2011. So my beginning balance of cash is $2,800. It's very important that you keep track of which year you're looking at when you have a balance sheet with 2 or more years presented. Make sure that you're using the right column for the year in which you need the information. Okay, so the final line is ending balance of cash. Ending balance of cash is going to be my net increase in cash plus my beginning balance of cash. So it's going to be the 600 plus 2,800. Okay, and I arrive at $3,400. Now, how do I know if that's correct or not? Well, I compare it to what my balance sheet says is my ending balance of cash. And my balance sheet says that for 2012, the ending balance of cash is $3,400. So I know that it's correct. If I didn't arrive at $3,400, then something is probably wrong in one of these 3 sections here. Something is probably wrong in net cash flows for operating activities, investing activities, or financing activities. That's usually where you would find the problem. And that wraps up Learning Unit 1, the indirect method. So when you take the quiz and the last exam, you might want to have this little cheat sheet handy so that you know whether increases or decreases in current assets or current liabilities are added or subtracted to net income. And then also remember, you have 3 sections. Complete each section one at a time, and then you have your summary at the bottom to show your net increase in cash, beginning balance of cash, and ending balance of cash.